When a corporate borrower first sits down with a commercial bank, the financial stakes are immediately quantifiable. Many entrepreneurs and finance managers operate under a persistent assumption. If they calculate their daily operating expenses and ask for 50 lakh rupees to run their business, the bank will sanction 50 lakh rupees. In reality, commercial credit appraisal does not work on request. It operates on strict quantitative assessment. This creates an immediate disconnect between the borrower's expectation and the bank's mathematical reality. We call this the appraisal gap. A business can show soaring annual turnover and a robust balance sheet, but that does not automatically qualify it for unlimited liquidity from a lender. Banks do not finance a company's total operational costs. They finance a highly specific structural reality, known as the operating cycle, using strict regulatory formulas to arrive at the final number. To accurately predict and secure an adequate limit, a finance professional must understand exactly how a banker builds this mathematical model, from historical CMA data down to the final MPBF calculation. The most critical variable in working capital assessment is time. This chart tracks the exact flow of funds. It begins at the cash out node, the exact moment a business pays its suppliers for raw materials. The clock starts ticking as those materials enter the production phase, sitting on the factory floor as work in process. Time continues to accrue as the final product moves into storage as finished goods inventory, eventually reaching the point of sale. But the cycle is not complete until the credit period extended to the customer expires and the cash is finally collected. This entire physical span, from raw material procurement to final invoice realization, is the operating cycle. Consider two businesses with identical annual revenue. A heavy steel fabricator might take months to source, build, and collect on a project. A fast-moving consumer goods distributor turns over its entire inventory in a matter of weeks. Even though their top-line revenue matches, the steel fabricator faces a massive delay between cash out and cash in. That delay requires significantly more external financing to keep the business solvent while waiting for payments to arrive. The physical duration of the operating cycle dictates exactly how much capital is locked up and unavailable for daily operations. To finance this delay, the bank translates the continuous timeline of the operating cycle into the static numbers of a corporate balance sheet. This chart shows how each phase of the cycle maps directly to an asset class. The raw materials, work in process, finished goods, and receivables stack up to form total current assets. This entire column represents the gross working capital currently locked in the business. However, the business does not finance all of this itself. The suppliers provide free credit. We represent this with a second column for current liabilities, specifically accounts payable. The difference between what the business has locked up in assets and what suppliers are floating in credit leaves an empty space. This is the working capital gap. The working capital gap represents the actual maximum deficit the business faces in its daily operations. The bank is only ever evaluating this specific gap. The credit appraisal process shifts entirely away from funding total operating costs and focuses purely on bridging this net structural deficit. To safely fill the working capital gap without over-leveraging the borrower, banks rely on regulatory frameworks, starting with the Nayak Committee guidelines for micro, small, and medium enterprises. For these smaller businesses, building a granular, item-by-item operating cycle model is not always practical. Instead, banks apply a standardized turnover method. Let us look at a standard MSME assessment. We begin with a projected annual turnover figure, in this case, 1 crore rupees. The standard working capital requirement is calculated by extracting a flat 25% block from that projected turnover, giving us 25 lakh rupees.
But banks mandate that the promoter maintains skin in the game. From that 25 lakh requirement, 5%, or 5 lakh rupees, is carved out as the required borrower margin, which acts as the net working capital. The bank then finances the remaining 20%, 20 lakh rupees, as the final sanction limit. This regulatory formula is built on a specific mathematical assumption. Extracting exactly 25% of annual turnover automatically implies the business has a standard 3-month operating cycle. Even within the simplest regulatory framework available, the bank explicitly enforces a mandatory margin. It will never fund 100% of the required capital. When assessing larger corporate borrowers, the process becomes significantly more stringent. Banks calculate the maximum permissible bank finance, or MPBF, using the Tandon Committee methods. This dashboard outlines a typical corporate assessment.
We start with total current assets at 100 lakh minus current liabilities of 20 lakh, resulting in a working capital gap of 80 lakh rupees. Under Method 1, the bank requires the borrower to bring 25% of that working capital gap, 20 lakh rupees, as their own margin. The bank finances the remaining 60 lakh. This configuration yields a minimum current ratio of roughly 1.17 to 1. While Method 1 is relatively lenient, Method 2 is the modern industry standard, designed for strict liquidity control. Under Method 2, the calculation shifts. The borrower is now required to contribute 25% of the total current assets, in this case 25 lakh rupees, as their margin, regardless of the liability offsets. Because the promoter's required contribution increases, the maximum bank limit drops to 55 lakh rupees, establishing a much stronger baseline current ratio of 1.33 to 1. By shifting the 25% margin requirement away from the net gap and applying it to total assets, the formula forces a higher promoter contribution and mathematically ensures superior baseline liquidity. The MPBF calculation provides a theoretical ceiling. However, the final sanctioned limit is almost always adjusted downward based on qualitative risk factors. To verify the inputs fed into the MPBF formula, banks analyze Credit Monitoring Arrangement, or CMA, data, which details a borrower's historical performance and future projections. This graphic shows the actual appraisal process. The raw MPBF limit enters the top of the funnel, but it must pass through a series of risk filters. If a borrower's projected inventory holding period exceeds verified historical industry norms, the bank manually trims the eligible total current assets, stripping away the excess. Overleverage triggers a similar contraction. If the total outside liabilities to tangible net worth is too high, it restricts the final, viable limit that exits the bottom of the funnel. A lower than requested sanction is rarely arbitrary. It is the direct mathematical consequence of the bank overriding optimistic borrower projections with verified historical data. Working capital limits are not subjective allocations. They are strict mathematical translations of operational time delays. A well-assessed business operates like a precisely engineered machine. Every day of delay in the operating cycle is accounted for and financed accurately. Banks finance the operating cycle, not aspirational growth targets, and they enforce mandatory margins to protect depositor funds. When we apply this framework, the appraisal gap disappears. The naive request for 50 lakh rupees is replaced by verifiable financial mechanics. Corporate finance managers can reverse engineer their exact eligible limit by applying these liquidity ratios and margin deductions before ever submitting a loan application. A sanctioned limit is not a flexible target to draw down at will. It is a meticulously calculated boundary designed to keep the business operational without over-leveraging its future.